Hi, everyone. This is Rohit from Lifestyle Mastery, and I'm excited to have Ross Fubini, who's the managing partner at XYZ Venture Capital, an early stage venture fund with a fintech and enterprise focused portfolio that includes investments in companies like Anduril, Hex, Bravado, Switchboard, and others. And big thanks to Manish Patel from Now Venture Capital for the introduction. Welcome to the show, Ross. Ross.
Thank you. Thank you so much. It's nice that all the best people know each other. So great that Manish was able to connect us.
Awesome. Yeah, no, absolutely. And you've had quite a very interesting career. You've been into as an operator and then as a venture capital. But what got you interested in this crazy world of venture capital and startups?
Yeah, my own experience moving into venture was just falling into it. It was not the grand plan. It was not the Harvard MBA that leads you there. It was really just the experience of first being an engineer at early companies like Netscape and Tellme, Symantec, and then I'd started a company and sold it. And coming out of the selling process, a friend of mine, Mitch Kapor, Mitch is very famous as the founder of Lotus 123, the original spreadsheet company. And he was an early stage investor and a tremendous one. And I just got the fortune that he was trying to scale up what he was doing at Kapor Capital, kind enough to invite me to come in and do that. He'd been an investor of ours. And so learning under his wing, again, sort of stumbled into this world where you get to work in service of founders, and have gotten to do that now at some scale at some big firms like Canaan, and certainly now at my own firm, XYZ.
Interesting. And obviously, Mitch is a big name, but you have built a company. I mean, you're part of Plumtree Software, and then you're CTO at CubeTree, which was later on acquired by Success Factors. But how was the experience of selling the company and then working in a larger enterprise company like Success Factors?
Yeah, I think the biggest thing I take from all those experiences, from being an engineer at Netscape to the acquisition through Success Factors, and which then got bought by SAP, I think the biggest learning I had was around different DNA of different companies. And it's that DNA is what enables the company to win. And in fact, might even create blind spots where it can't win. So as a real example, success factors, really had tremendous. So success factors was one of the early SaaS
Yeah.
companies, and was tremendously successful building a set of HR services through no part of ours. We were acquired by them. But building these HR products around recruiting, performance management, et cetera. And it had two benefits. Number one was it was benefiting from the early wave of SaaS. So you could just move so much faster than existing competitors because you were hosted software. Well, we all take for granted now.
Yeah.
And then secondly, it had a tremendous sales culture. Now, those two things are how that company was able to win. And that's just a very unique set of circumstances, which is very different from other companies that we've invested in over the years. For example, you mentioned Anduril. Anduril is now a very large and well-known company here in the US that is a modern defense contractor building solutions for the government. What they similarly understood was a combination of how to sell products to the US government, but also how to wildly, rapidly innovate and create new products. So it wasn't their ability just to sell, it was to sell, it was to figure out what the government most needed and then generate solutions that could be adopted and moved through that sales channel. And that's what enabled them to be successful. So I think the biggest takeaway from all these experiences, Netscape, Tellme, Plumtree, Symantec, and all the businesses I now get to see, is I'm always trying to figure out like what's going on culturally in that business that enables it to succeed, and it succeed uniquely in its market. And it's different for every company. Once you understand those things, lean into them, and also don't count on the things that you're not great at.
Yeah, yeah. No, interesting. You talked about success factors. But if you look at today's time, I think AI is eating into the margins for SaaS. But do you think the SaaS founders need to be worried, or do you think it's the revenues for AI companies is going to go down, and because we see a really betting big on AI startups now, but do you think it's going to improve with M&A and IPO market opening up next year?
Well, it's hard to know. I think the things that are undoubtable right now is the AI technology is going to change many, if not all, the applications that we use, from sales to support to the support centers of ServiceNow of the world.
Yeah.
The second thing is, I think without a doubt, the incumbents are benefiting hugely from the AI adoption within their existing within their customers. They would have the customers, they have the data for those customers, and so much of the power of AI is that it can be easily applied, and so you can have your AI-powered agent inside Salesforce, your AI-powered agent within inside Workday. Pick one of many examples. I think the opportunity is going to be for transformative applications to exist. This is a well-known metaphor, but many people had mobile apps, but we're waiting for the Ubers to emerge. These completely novel solutions and products that can only exist because of AI. And those are going to be bigger than even the existing incumbents. We're just early on in seeing them.
Yeah, absolutely. And another thing you mentioned about Anduril, and you're at the seed stage. How did that deal happen for you?
I'm sorry, Rohit, could you repeat the question?
Yeah, you mentioned that you got in early with Anduril at a seed stage. How did that deal happen for you?
Yeah, it's interesting. Maybe two things about that. The first is the precursor to Anduril was my involvement with a company called Palantir, the big data company.
Yeah.
And again, I just had the good fortune some years ago to connect the first employee at Palantir to the second, and they're both now on the leadership team, Aki to Sham there. And I had the correct insight that Palantir then and now was just going to have an incredible set of technologists that were going to build applications in some of the most difficult companies, the most difficult areas in the world. So that was in the government, fintech, oil and gas, these areas that hadn't been transformed by technology. And so I was intimate there, close to so much of the exec team, so much of that company growing up. So then when one of the most talented executives, a guy named Brian Schimpf, was going to leave and go work with friends of mine, Matt Graham and Trey over at Founders Fund, to say it was the easiest decision in the world to give them money is an understatement. Truly, folks, you would have backed building a toaster company. The second thing I want to say about that, for them as founders and for me and as an investor, this was not an obvious company. Folks on this listening to this podcast might know this is now very hot. They might be excited about all the products that Anduril has built, all the disruption it's bringing to the defense market. These were not obvious things at the time, but this team was clearly tremendous, and the opportunity to build a novel company in the space that just had not been done. They were clear-eyed on that opportunity. So it was a very easy decision for me to do, though it happened to not be obvious at the time.
Interesting. And before the call, we talked about how you were part of XYZ and Village Capital. So how did that happen? I'm a fan of Eric Torenberg and what he's built with On Deck, but how were you able to manage both the funds?
Yeah, so I had started XYZ venture fund, focused in great part on backing people out of the Palantir ecosystem. I really believed in this network was going to have these incredible businesses. Then what happened was I had met Ben and Eric when they were starting Village Global, along with Ann Dwayne through
Yeah.
my friend Reed Hoffman. And Village Global is another venture firm that had a similar view around the power of networks. Can I take the most famous people in the world, Reed and Zuck and Bezos and Bob Iger and Barry Diller and Sarah Blakely, all these people, and can I build a venture fund around those folks? And that's what we did at Village. And so I ran both XYZ and Village Capital for a while, which basically would have given gave my LPs a stroke, because a lot of jobs. That said, I was just so excited to go build with them, build that network, and have XYZ at the same time. In 2020, I went back to just focusing on XYZ. I love the Village mission, but I really, probably like so many people listening now, I just loved building my own firm and having a view of the network that I wanted to build just around XYZ. And that's been very fortuitous. We have a little over 130 companies in the portfolio now, and about half of them come immediately from introductions from one founder to the next. One founder we work with introducing their best friend, in some cases their wife and partner, to us as a founder that we should back as well. And I love building out those networks. It's been tremendous building that now here at XYZ and having our own network of networks starting to emerge, particularly in these areas around the public sector, the things emerging around Anduril and the other companies we've backed, selling tens of millions of dollars and up to the government, building those kinds of expertise areas around tax, around procurement, around AI services, all that kind of good and rich stuff.
Interesting. And, the last couple of years, the VC landscape has totally changed. I think, I think that it's becoming difficult for LPs to, get that liquidity and that exit. But what would you know now that you wish you had known when you would enter the VC world?
Oh, I mean, a thousand things, a thousand things. The first thing I want to say, though, about raising funds, so I've raised 4 XYZ funds in the last few years. And every time I've done them, there's an old movie, Men in Black. And the start of Men in Black, Will Smith is joining the Men in Black, and he's like freaking out because there's some space alien. And the other guy, whose name I forget, says like there's always an alien invasion, there's always an asteroid, there's always a plague about to hit the Earth. Venture's the same way. When I was doing the first fund, it was like, what are you doing? How can you have a seed fund? You don't know what you're doing. When I did the second fund, it was, wait a minute, don't you realize there's hundreds of seed funds? How are you differentiated? When we did the third fund, it was like, don't you know that COVID's going on? Like, who raises money during a pandemic? When we did the fourth fund, it was when like the market was correcting and crashing. People like, wait, we have no money at all. How could you be raising capital? And now it's like, well, nobody's exiting. Our DPI is in trouble. So I think first, there's just always a crisis. There's always a difficulty. And so that's my experience, is that there's always a crisis. You're building through it, no different than any other founder creating a thing. And you're trying to force and will your idea forward. The second thing that I think venture, it really is an execution game, is my view. So like, what's the answer? The answer is usually work harder with the smart people that want to be in your founder network. And that execution leads you to founders that refer other founders. So you now have an answer to how do you source people? It's like, well, I did great work with Rohit. That was transformative. He introduces me to other people. Again, it's not magical thinking, but it's a very real way to build a venture firm. Maybe the third, I want to give you one more if it's okay.
Yeah. Yeah,
This
absolutely.
is a real deep learning for me at this point in my career. I've been in venture stuff like 14 years.
Yeah.
And right now, I would say my insight is I have one job. My job is to help our founders raise their next round of funding. What that means is from the minute we meet, from even before we invest, to obviously post-investment, day one, onward, what I'm thinking about is what are the major risks we have to take off the company based on the next round of funding. The next round could be an A, it could be an IPO, but the value there is every single founder we work with knows their business better than we do. But we have the benefit, I have the benefit of I know the venture ecosystem better than anybody else. And I can take the understanding of that company and the venture ecosystem and say, like, everybody believes you can reach customers in a single vertical. We got to show the next vertical. Everyone believes these customers will buy, but TAM is the big issue. Show hints of an additional product. Show we can do, ASP expansion. Lean into our NRR because our NRR is 140%. So let's focus on that, not new customers, or maybe actually we don't understand the new customer motion as well. So it's which facts do you want to get to that are the ones that show this company's de-risked and therefore raising more capital. And the piece of that, the reason I weigh that so strongly is because then I know what my value is uniquely in the room. And it is a very high value to those founders. So it's a very deep partnership, more than like, we're pals, we helped you recruit someone, we're a thought partner. All that is true. But it's like the basics. It's like you've got lots of friends, right? But the friend that introduces you to your wife or your partner, they're special. So the friend, the venture partner that works, and we're working against your next round of capital, taking those risks out, telling that story, then who to tell it to, like that's a transformative relationship. And that is what I want to do, what I'm trying to do with our founders. And that's very clear-eyed for me. When I do my work, it's the thing that we think about with me and my partners of what we're trying to get better at. And it creates a virtuous cycle that goes back to that network. Because if you're doing that well, that founder has an incredible experience. They introduce us to the next person. And that's the flywheel of success that you're trying to create in this weird little universe of venture capital.
Yeah.
In my view.
No, absolutely. Yeah, I mean, you mentioned about DPI getting worse, but I've seen that in the last couple of years, VC funds are becoming bigger, and there's a lot of cash that has entered the VC industry. But do you think the returns will simply get worse, or do you think with newer technologies like AI and all, it's going to get better?
Rohit, the returns were always terrible, but for certain venture funds.
Yeah.
It all depends on the people. And folks forget this. There's some venture funds that do tremendously well, and then some that just don't. So that's probably the first thing. No different than any other business. There's goods and bads, and there's lucky and unlucky, all that stuff. So but the average venture fund is not a terrific place to put capital. Now, small number ones that are great, they are tremendous. So with that lens, what do I think is great? What have we seen? One, those multi-stages, they are great. They're going to be a lower returning. If you're returning $6 billion, a $6 million fund, you are going to be a lower multiple returning fund. But I can now tell you, because I live in these worlds, there are people that this is great for, because they need to put $500 million into someone that they trust, that can operate, that can execute in this weird asset class, and is driven to success. That success might be a 3x net, which is not sufficient for the kind of risk we take in our part of venture, but it's a reasonable, it's a very reasonable thing to do. So I think those larger funds, they will return lower net. I expect, my experience, not as an LP, as a GP, they would return lower net multiples. But the cash on cash in some of those firms is going to be tremendous, because they're going to be well run for what they do. Now, we are a bit smaller. We're not the smallest. We're a bit smaller fund. So we have our own excellence we need to do. And that's how we think of XYZ, is where can we be aggressive in terms of deploying dollars, but then advantage to returning 10x net funds. Like that's our goal, and that's our true north. So again, I think it just varies a lot depending on firms. It is the case, additionally, that right now there's not as much liquidity in this category for sure, but it means that there are people that are moving capital because they need to reallocate because they've realized those large funds aren't going to return fast. So that's an opportunity. There are other folks, by the way, that are reallocating. Say in the US, there's a lot of folks that are allocating dollars out of China because that, instead of being a high growth market, feels like for them, a structurally risky market. So there's lots of changing pools of capital. And I got to tell you, there's a lot of capital out there. So it's about execution, which is hard. It's about trust and transparency with your LPs. And that's the process to going and just building a great relationship with your capital partners. So it can all be done. It just was always hard.
It was.
Our version of it being hard today is different than it was a year ago, and it'll be different in another year from now.
Yeah, no, absolutely. And on the point of liquidity, do you think what do you think about the state of the IPO market? Do you think it's expected to open up next year with more M&A happening, deals happening?
I think we're going to see more M&A, if only because we've seen so little this year.
Yeah.
There are two big reasons for that. One in the US is because of regulatory concern, and we think that's probably going to get lessened to a great degree. We'll see. The second is the value of cash, particularly through 2023 and into 2024. The certainty of cash has been much more valuable for companies than the benefit of buying a new business, buying a new team, buying a new product, buying a growth potential. And so that's really dampened excitement for M&A, in my view, across the board. So I think we're going to start seeing more excitement there. I suspect we're going to see everything from big dollar M&As where the public markets are going to start rewarding growth as interest rates have moderated and all those macro trends. I think we're going to start seeing acquisitions where existing companies are going to realize they have structural, fundamental risks where they have to bring in AI technology to compete with emerging challengers. And I also think we're going to see the beginnings of some very large scale companies starting to go public, getting everything tightened up, and they're gonna see folks wanting to just buy those businesses and sort of be better together. So I think all those attributes mean we're going to see more in the M&A front than we have in past. But really, we're coming out of a bit of a desert for M&A overall. And again, this is very typical in cycles, right? Like everything kind of, broadly speaking, has gotten tighter. I'd rather have money. A bunch of companies die. That sucks. And it's sad. A bunch of other companies really mature up and they perform. They're a better business. They have a lower burn rate. That makes them a better acquisition target. Those founders, instead of saying every single, company is going to be worth 20 billion, they're like, boy, the thing I just did was really hard. If I can get an acquisition for $1.5 billion, maybe I'm willing to take that. And maybe there's a buyer out there. So I think we're heading towards more activity overall would be my expectation. Who knows on the IPO market? That's definitely a crystal ball. I think in part because it's still so expensive to go through the IPO process. And expectations there are, you're in the hundreds of millions of revenue, not in the, just burgeoning towards 100. And that's a real change, as compared to 5 years ago.
Yeah.
And I think that the public markets are really still rewarding profitability and very profitable growth. So that's another downward pressure against going an IPO versus staying in the private market. So it's a mixed bag.
Yeah, no, absolutely. And I've seen that around 30% of all the VC funding is getting into AI. But what do you think are the biggest mistakes VCs in how VCs make decisions these days?
I think the biggest challenge in doing venture is partnerships.
Mm,
Because remember, all of these firms, ours included, is that it's not one person making a decision, it's one person making a decision in a partnership. And the
mm,
reason I mention this is because most of the stones you can throw at decision making or the challenges of it are where a partnership can fall in love with a category. We should be doing more in GovTech as a partnership where you can be excited because you're out and looking for companies in a category that maybe you're not expert in, and then you're going to get really excited and you're going to overpay for a thing. Same thing in AI. Let's pick on AI for a minute. So
yeah,
AI infrastructure, for example, is an area where there's been a lot of excitement, a lot of money spent. People are going to make some money, and a tremendous amount of money is going to get lost. Tremendous, because an immense amount of AI infrastructure is going to get either open sourced or provided by the hyperscalers, including OpenAI among them. And I think that's going to erode the value of AI infrastructure investments. Doesn't mean there aren't good ones, but I think that's a real challenge. And I think it's an honest mistake because historically there's been so much value in technology infrastructure. But I think here there's a bit of disconnect for how much the open source and how much the scaled players are going to provide for you. So that's one example of real challenge. A second example, which again, we're participant in these, we're just trying to think we're smarter or figure out our mistakes faster. A second example that's happening right now is there's a lot of collision right now between venture and private
yeah,
equity.
mm,
And this is a correct idea because what I believe is 10 years from now, some of the biggest companies in the world are going to be AI powered companies that are eating service categories, whether accounting, legal, other areas, consulting. And the AI technology is going to enable these huge new players. They're going to eat whole categories the same way like what Uber did to transport, right?
yeah,
Mobile plus flexible workforce did today. We're going to see that. Can't totally tell yet, right? But it's going to happen. But because you can't tell, some people are going to make some bad mistakes. There are going to be some venture people that have great technology, and they're going to be like, all we have to do is acquire a bunch of folks and roll them up. And the real challenge of that story is humans. Humans are complex to roll up. Do customers move over? Is the technology really good replacement? I'm not saying that any company is a bad idea. I'm saying that is an idea that is reasonable, that's going to be expensive when you get it wrong. Some
yeah,
people are going to right, a lot are going to get it wrong. So we're going to go through a mini or not so mini version of the .com bust where like e-commerce is going to be everywhere. Correct. But the trite, we're going to have some pets.coms. They're
yeah,
going to blow through all the money and they're not going to work and they're going to make very little value. And we're going to get some Amazons in the process as well, of course. So I
yeah,
think that's what I observe. That's what I observe right now. Well, another time we get to the boring nitty gritty, which is I think the way venture funds get in trouble is actually then deploying not the first dollar, but the reserve dollars
mm,
into those companies. The way this works is venture firms do an investment, and many of the funds, reserve. Say for every dollar we invest now, we're gonna reserve another dollar to invest in later stages. And the danger there is you invest in that first thing and you were right, and you had a great insight, and everybody else put more money in. You put more money in with them, and you were all excited, and all the prices went up, and then that company didn't work. So it's not only that you lost one slot or one company, it's that you lost all the other dollars that went behind it. And that's a challenge when you're in this very excited period, because you can be overexposed capital wise to a set of ideas. And this exists in this category, it exists in space, it exists in anything that's like new and exciting, but it's full of unknowns. And so I think you have to be very honest as a venture capitalist and as a founding team of like, are you finding real both market fit? Are you finding are you getting capital leverage? Sorry, are you getting technology leverage in this PE example? You have to constantly be excited, but hold a skeptical mind at the same time. And the best founders, they do this, and they do this naturally. They can tell you the opportunity, they can tell you the downsides, but it's a real challenge. It's a real challenge to do. And then the capital version of that is just put more and more dollars into those things, not being honest about those risks.
Correct. And when you talk about founders and when you look at investing into them, do you prefer experienced or first time founders when you're investing into them?
I look for three things, and we can see it whether it's like someone coming out of college as an undergrad or someone that's been in the industry for 40 years. Which is, number one, you got to execute like a son of a bitch. Like I believe execution solves so many problems, and that can exist in many different people. They can have a pedigree, or they can have grit, or sort of pick your example, but many places, that's what we look for. The second is we want to see someone that actually has done the work and has a deep insight. So that's an undergrad who can tell you that they called 50 people nights and weekends to understand why this vertical is going to buy software from them, or it could be a security leader who is a CISO who's seen everything under the sun. So it varies. The third thing, though, it actually is independent of the founder, which is, I believe, you have to have something that's structurally changing in a market that is to the advantage of that company. There's this trite but very good metaphor of like, you have to be on a wave because your company, your founder, they're like the surfboard, and they can have the right idea, this is the place to be, and they can be executing, so you're paddling really fast, but if that wave doesn't pick you up and push you, it's just so hard. So I think you also have to have this market changing to your benefit. And so we look for those things: execution, insight, and then this market change. And I actually think you have to have all of them for something to work. Now, the best founders and the luckiest founders and all that kind of stuff, sometimes you think you're on one wave, that didn't work, and you move to the other wave. But ultimately, those three things have to come together. And so as a venture capitalist looking to partner, you're trying to assess these three things, but it really does vary, or you can see it in different types of people. And in fact, we're very open to very different lived experiences if we can see these three attributes going on within a company.
Got it. And as XYZ Capital, what do you prefer, a founder or market? What do you prioritize more?
I don't know if this is right. We probably prioritize just the execution ability more than anything else, especially in the early days. So if we believe someone can execute like crazy, maybe this market seems smaller, or this product. We have a company called Scribe, scribehow.com. You can go there. They have a plugin that you can use that as you use web applications, it can generate a how-to.
Okay.
It's tremendously successful, but it appeared as a small tool, but it had just incredible go-to-market motion, incredible product market fit. So you can appear small in the beginning, because I believe the execution, the iteration speed is what you need. And then as you scale up, that execution, that theory of the market, you've got to come into a big TAM ultimately. But mostly, I think in the early days about execution. And then second is that execution showed that you find a way out to market, a unique distribution path that that's going to enable you to go own a category dramatically.
Got it. And what's your biggest lesson when it comes to market sizing and timing?
It's mine is this one that I mentioned, is that you have to find pull in a market. You have to find this change that's moving to your benefit. And if you don't find that, you need to keep moving. Like you you won't be successful the long term. You might go from 1 million to 4 million, and you might even be thinking you're going to 4 to 10 next year, or whatever is, a good approach. But the difficulty, if that market isn't transforming, if you're not able to create that transformation where you get real efficiency, you're not going to win. You're not going to build a really big business. You need to keep looking for how is your solution going to benefit from this market shift going on. And that's my answer. If we don't have that, there's this, it's product market fit and it's distribution fit. Because when you get distribution fit, everything just goes faster, so much faster, much faster.
True. And how do you get to decide, when to sell in your portfolio? Should you sell when the founder also sells, or do you have like a, I think Ventures talked about, 30%, like, when they sell a portion of the portfolio, they keep 30%, they sell 30%, and then whatever. So
We don't have a firm rule on selling.
okay.
What I believe is that I'm trying to figure out what is the maximal value of the companies that we're in. I'm just trying to talk to the founders. Is this company worth $100 million? Is it worth $500 million? Is it going to be worth $50 billion? And what do the facts tell us about how that's unfolding? And so that's how we think about the value of all of our positions and all of our companies. And I'm just trying to do whatever I can to help the companies get to that point, or beyond, to discover their maximal value. So that's really how I think about it. Where we would sell or not sell, it's not a big part of the dialogue that we're having with our companies, unless it's in some way beneficial to them. And there we err to the side of doing right for our founders. And that's my overarching mindset.
Got it. And when it comes to providing value to founders, other than capital allocation, how can VCs provide any value to the founders?
Yeah, my own view is, number one, it's been said before by others. Number one is, like, first, do no harm. I really do think there are a lot of folks that work with great, responsive, attentive founders, and then just cause them to spin their wheels because they're concerned. The venture people are nervous. Their partnerships are beating up on them. They're worried they're going to get fired. So they need to create this work to try and comfort themselves. And that's very human, but that's very damaging. And I think they need to, first, do no harm. My second view of this is what I said, is I think we have one job, and it's to work to help that company understand what's going on in the venture capital market, understand where their company sits in that market. I remember years ago, I was on the board, early days of my career, with this guy from Bessemer. Long story short, we're involved in this company, and he really wanted the CEO to sell this business that was doing very well, because he'd observed we had two parts of our company, and he'd observed that one part was working and we had revenue growth, and the other part was working at user growth, but people wouldn't value those two things together. At the time, I thought, that guy's wrong. These things are great. In retrospect, he was very wise and very correct, because he observed that the market was not going to value those two things together. So we had no strategic buyer. So we either had a buyer for one or the other. And at this moment in time, we had a buyer for one and not for one of them, and we should have sold the business. And so his instinct was exactly correct. And I think about this because what I want to have is an insight in that moment to explain this to the founder. Not that they should sell their company because it's bad, but they should look at how the market is going to perceive their company. And either there's an answer to this, which is like, it doesn't matter, we're unique, we're going to put these things together, and it's gonna be a rocket ship. LinkedIn did this in spades perfectly. Um, of developing this asset and this revenue is just one of many examples. But if you can't do that, you can't answer that question, how these two things linked together are going to make you a public company, you should realize in this example that you have a drift where the two parts of your business are not going to be valued together, they're going to be valued separately, and then think about what you should do as a result. So this example I use is one because I'm embarrassed that I didn't grasp it at the time. That's a good life lesson, and impressed by my friend. And then secondly, it's how I think venture people should always be thinking, which is, what do I understand that the founders don't in that room? And bring that as a valuable part of the discussion as a second thing. See, point one, don't do no harm first. But that's my own view.
Got it. And the last couple of years has been hard for emerging managers who are trying to raise funding, right? So, what advice would you give to emerging managers looking to raise their VC fund?
But I would say, in no mean way, raising funds has been hard for some emerging managers,
Yeah.
not for others. And the advice I would have is, number one, having a very clear view of the thing that you are doing better than anyone else. And then the second, which I think about at the time, is just having a really rigorous qualification process, no different than you were in sales. And it's because when I was raising our earliest funds, oh my God, it was so emotionally exhausting. Because I'd be like, Rohit, you got $100? I'm raising a venture fund. Like, I was always trying to I'm calling Tomasik, which is like managing $100 billion, and be like, I got this little venture fund, you should give me 10 million. That's a dumb thing to do. Don't call up IVP and try and raise your seed fund. They're a growth firm. So I think the sales qualification matters tremendously, constantly, and then figuring out who wants to buy or who wants to invest, who wants to buy with what you're selling. And my lived experience is you literally know that in the first meeting.
Mm.
And that's been my process. If I could say one more thing about it, because I think about this a lot, because I want other funds to be successful, is we've through laziness, we've only ever raised money from LPs that our existing LPs introduce us to. So that's where we spend all our time. We don't go outbound. We don't go to conferences. We don't. And we started with a very small number. We didn't start plugged into some rich ecosystem of billionaires and pension funds. And so my experience is just spending time with the people that already know you, that already trust you. Say, hey, who else do you know that we could go talk to that likes what we're doing? Because it's so much more efficient than just trying to go out there and grind through some other discussions. And so this was my own lived experience, which, by the way, if anyone listening is a salesperson, you're like, duh. Like, that's literally what salespeople do, nothing but think about is qualification and like selling to, warm leads, right? And that's the same thing I think here. And so that's something I think a lot about. And raising money is incredibly difficult. But if you're doing these kinds of, like, you have a tight definition of what you're doing, you're walking warm relationships, I think you can be very successful.
Got it. No, absolutely. It totally makes sense. And I quickly want to do the top three. What's your favorite business book?
Oh, I know you asked this question. I thought about it a lot. I don't have an answer for you because I don't like business books. Though the one thing that I would highly recommend is, I love the Acquired podcast as well. I love this podcast. I love the Acquired podcast because when I listen to it can be a little bit self-aggrandizing towards founders at times. And definitely for when it covers venture firms, really quite self-aggrandizing. But I learned so much from those in-depth histories of companies, these little twists and turns. I'm really enjoying the IKEA one right
Yeah.
now. And so I think I think that's a really special way to learn. So anywhere where you can find that kind of history of a company through acquired or through books about there's actually a great bio or great history of Oracle that I love. I wish someone would write one about Netscape, which, so anyway, that's my answer to that.
Yeah, no, absolutely. I absolutely love acquired podcasts. We're going to put that in the show notes. And if you could go back in time when you started at XYZ Venture Capital, what is the one thing you would have focused on or done things differently?
The one thing I would have done differently is the on the fundraising, actually. It really was very, very, very hard. And I would have thought about talking to people who I raised funds from who really wanted to do the thing that I was passionate about, who understood in those days how my insights around the Palantir ecosystem and trusted that judgment. And I think that would have saved me a lot of emotional energy, and I would have moved faster in retrospect. So that's probably the biggest one. The biggest learning we've also already covered, which is this: you have one job and to raise the next round of funding, and that's been a real lived experience and lived journey.
Got it. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
I'm gonna just give my plug for Notion. My
Yeah.
one of my partners is the old CMO of Notion, so
Nice.
I wanna help her out always, her stock ownership position. But
Hmm.
also, I'm just amazed that company has just such tremendous collaboration tools. They now have a new email product and a new calendaring product, just the velocity of which they're taking on big um, productivity categories. I'm blown away by, and I'm just becoming more and more bullish on that product as a user every day.
Yeah, no, absolutely. I totally love Notion. We're going to put that in the show notes. And Ross, what's the best way people can know about you and about XYZ Venture Capital?
Yeah, if you want to reach out to me, you can reach out via email at Fubini, Fubini at xyz.vc, or I'm very findable on LinkedIn or anywhere on the internet. There aren't a lot of Ross Fubinis out there.
Got it. We'll put that in the show notes. Ross, thank you so much for taking your time and speaking to us. I really enjoyed my conversation with you.
It was great. Thank you so much, and thank you to all your listeners.